Good morning. I'm Larry Bormel, president of Bormel, Grice Huyett. We're very proud to bring to you our very first webinar, which will be on individual income tax tips. Want you to know that we're also planning future webinars that will be put on from some of our specialty groups, including planning for estates and trusts, not-for-profit organization issues, real estate and construction issues, and tax planning for professional service providers. I want to start by saying thank you to Bernie Eisenberg and Marty Janoff from Mid-Atlantic Streaming Video for all their logistical help and for producing this webinar. Today we will be presenting some tax tips, some topics, and we will also be fielding questions from you. And I have with me members of our tax department, and we have a multicultural panel today in that we have our Director of Tax Services, Mike Myers, who's a lifelong Redskins fan. We have one of our tax managers, Barry Fields, who is a lifelong Giants fan and the only team that's still in the Super Bowl represented in our office. And off camera, we have one of our tax managers, David Young, who is a Pittsburgh Steelers fan, boo, in that I'm a lifelong Ravens fan. So we're well represented, as you can see, by all of the area football teams. Hopefully, they will be as sharp with their answering your tax questions as they are with their football trivia. So in any event, we're going to be fielding questions from you, and you can start typing in your questions. We'll get your emails as they come in, and we will try to be answering your questions as we go along. I have to tell you that because the answers that we're providing are spontaneous, we're urging you not to act on that as advice without calling us first to consult on your specific situation. So that's kind of like our disclaimer in this whole thing. We want you to email your questions to lbormel@bormel-grice.com. That's lbormel, L-B-O-R-M-E-L, @bormel-grice.com, and we will do our best to answer your questions, time providing. I want to start by filling you in on some tax tips. I meet with hundreds of clients every year, and based on the questions that they have and the situations they have, I've identified 5 areas which I like to call the most commonly overlooked or underutilized tax deductions. So I'll give you a brief overview of each one. Hopefully you'll find this helpful. Many people in business use their autos, their vehicles, for business purposes. And if you're like most people, you probably have more than one car in your household. One car that's probably all personal use, maybe your spouse drives that car, and a second car that might be primarily business use. So how can you maximize your deduction of your vehicle? Well, you have 2 choices in terms of deducting expenses relating to your vehicle. One is to deduct actual expenses, and the other is to deduct a standard mileage rate. In 2012, the standard mileage rate is 55.5 cents per mile. So for example, if you drove 10,000 business miles, then you can deduct 55.5 cents or $5,550. That's great for people who don't really want to keep track of their gas receipts and all the repair receipts and everything like that. The mileage rate's perfect for them. Alternatively, you can deduct actual expenses. What are those actual expenses? Gas, insurance, repairs, interest on car loans. Also things like, don't forget your AAA membership, your MVA fees, and also depreciation if you own the car, or your portion of your lease payments if you are leasing the car. Couple things to remember. One is that if you pick actual or standard mileage rate, you have to stick with that method for the life of that vehicle. Once you buy a new car, you then have the opportunity to evaluate whether the actual expense method or the standard mileage rate method is better for you for that particular vehicle. As far as if you own the car, you can take depreciation on the business portion. If you lease the car, you can deduct a portion of your lease payments. The way that's set up is that the government has tried to make leasing a vehicle and owning a vehicle a non-issue from a tax perspective. So they have limitations on the amount of depreciation and on the amount of lease payments that you can deduct. We get a lot of questions all the time from clients: should I buy or lease? How should I treat this? Should my company own the vehicle? Should I own it? All kinds of questions. We know there's a lot of issues relating to that. Please call us if you have specific questions about your situation, and we'll be happy to help you with them. Second topic, as far as commonly overlooked or underutilized tax deductions, is meals and entertainment. Well, what are we talking about with meals and entertainment? Meals, of course, breakfast, lunch, dinner, or a cup of coffee with a client or prospect. Entertainment, what are we talking about? Well, perhaps you tend to go to the theater, or maybe you go to sporting events, kind of like this group here, or maybe you play golf. There's a lot of business done on the golf course. So what is the criteria that has to be met for your meals and entertainment to be tax deductible? First of all, they have to fall under the general category of being ordinary and necessary. Well, what does that mean? Ordinary means that it's common and accepted within your industry. Necessary means that it's helpful and appropriate in carrying out your business functions. A couple things that you need to know. One is that meals and entertainment, by law, are only 50% deductible. So if you incurred $10,000 of expenses during the year on meals and entertainment, you're only going to deduct 50% of it, or $5,000. That's the rules. That's the law. There is a difference between meals and entertainment. There's a requirement that the main purpose is that you conduct business with some expectation of getting some specific business benefit out of it. The meals, the business discussion has to be conducted during the meal. The entertainment, it doesn't. Why? Well, because if you're in the theater, for example, and you're watching a play, you can't be conducting a business while it's quiet. So you are allowed to conduct business either immediately before the entertainment event or immediately after the entertainment event. And the key to the whole thing really is documentation. The who, what, when, where, why. So if you get a receipt for dinner, for example, the where is going to be printed on the receipt. The when will be printed on the receipt. How much will be on the receipt. So what do you have to do? You have to put down who you were with, what the business relationship to you is, and what the purpose of the meeting was. So, for example, I was at dinner with John Doe. He's the president of XYZ Company, and we were discussing proposed merger with ABC Company. That goes on the receipt. You save the receipt. Boom, end of the story. So let's pause here, and I hear my computer beeping, and we'll see if we have any questions. And I'll go to one of our tax managers, David Young. David, can you let us know if we have any questions at this point?
Yes, Larry, we do have a question. We have a question from Bill, and he's interested in the new reporting requirements for stock sales in 2011.
Okay, Mike, would you like to field that question?
Sure, I think I can take that question there. There actually have been some significant changes for 2011 and how stock sales will be reported. They'll no longer be reported directly on Schedule D. They'll now be reported on new Form 8949. The totals of the Form 8949 will flow through to the Schedule D. So the Schedule D will still be utilized in the reporting requirement, but the individual transactions will be reported on the new Form 8949. One of the other changes have to do with the 1099-Bs for 2011. Beginning in 2011, the basis for stock transactions will also be reported on the 1099-B. One of the questions that has come up from quite a few people is, well, what if the basis is wrong or different than what's reported on the 1099-B? Well, if it is different, it could be different maybe because of an inheritance, a gift, or maybe even a wash sale. So if the basis is different, the form has codes that are reported to indicate that there is a difference of what you're going to report on the Form 8949 and the 1099-B. And there's also an adjustment column that will report what the difference is. So this is a pretty significant change for reporting stock transactions, so please be aware that the process gets a little bit more complicated, and we are certainly available to answer any questions in regard to those filing requirements.
Thanks very much, Mike. I can see that we have other questions that have come in, and also I've had a couple of emails from people that said that their videos are blocked by their company's system or whatever. This webinar will be on our website at some point. You will be able to see it or refer back to it. David, do we have any other questions?
Yes, we do, Mr. Bormel. We have a question from Ashley, and she's interested, are there any tax benefits for residential energy improvements this year?
Okay, well, I know for sure that I'm going to ask Barry Fields to answer that one because he's our green guru, green expert. So, Barry, take it away.
I'm glad you asked this question. As Larry just said, one of my specialty areas is assisting our clients in their efforts to go green. In fact, I'm also the treasurer of the Green Building Institute in Jessup, Maryland. The energy credits, residential energy credits, fall into two buckets, what we would say energy improvement and energy efficiency. For energy efficiency, such as windows and doors, the maximum credit in 2011 is $500. That's a combined maximum. There's a schedule of credits giving various amounts, such as for windows, doors, insulation, heat pumps, HVAC, furnaces, but the combined total is $500 in 2011. And if you've taken credits prior to 2011, $500 or more, then there are no credits for 2011. Also in 2012, this has expired, so there's no credits of this nature for 2012. For energy improvements producing energy, such as solar power, solar water heaters, geothermal, wind, and fuel cells, the credit available is 30% of material and labor. So if you spend $30,000 on a system for your home, a solar system, the credit is $9,000, 30% of that. A few things to note is that it does not expire until 2016. So there are several more years for that. But the catch there is for alternative minimum tax, the credit is not available in 2012. So for 2011, if you spent money on that, if you're expecting those credits, you're still okay. But if you're looking into this now, as the code is written right now, you will not get that credit if you're in alternative minimum tax. So just be on the lookout for possible law changes to alternative minimum taxes.
Thanks, Barry. Oddly enough, one of my sons was asking me the other day about energy credit and about the $500 credit. And he said, Dad, did you ever take energy credit before? I said, yeah, a couple of years ago we took the $1,500 credit. And he wanted to know if that precluded me from taking the $500 credit this year.
Yes.
Yeah, and that's what I told him. So, okay, thanks very much, Barry. David, can we take another question?
Yes, we have another question from Sally, and she wants to know what kind of tax deduction can she get from donating her clothing, furniture, and other items to charities.
Well, guys, I guess it's my turn, so if it's okay, I'll take that question. A lot of people every year do spring cleaning, clean out their house, and have a lot of things to give away. These may be articles of clothing, could be furniture, could be televisions, computers, whatever. And typically, they're donating it to a lot of worthwhile organizations like Goodwill, AMVETS, Purple Heart, etc. So what happens is when you take those items or they get picked up, the organization typically gives you a receipt. The receipt, as you may know, has very little information on it, usually has the date, somebody's initials scribbled on it, but they don't really even go through at that point what you've given away. So what we suggest is a few things. One is make sure you keep the receipt. Why? Because the receipt is the only evidence that you have that you actually gave something away. So the receipt becomes very important. Number two, make your own list of what you gave away. I gave away 6 pairs of pants, 3 shoes, 2 suits, etc., etc. And we suggest that you make 2 columns. One is what the item typically would cost new, and the other what the market value is. And if it's in good condition, we usually suggest 25% of the new cost. So if you give away a pair of dress shoes that are in good shape and that they originally cost you $100, the value you would claim would be $25. And so some people say, well, I do this a lot, I give away a lot of things. Is there a range that I should be looking for in terms of donating? And there's a couple answers to that. One is the average published is about 1% of your adjusted gross income. So if your adjusted gross income is $200,000, about $2,000 worth of non-cash contributions is not unusual. Secondly, if you give away a lot of items, like when you're moving from one house to another and maybe you're giving away lots of furniture, etc., you cannot claim more than $5,000 without getting an appraisal of what you are giving away. So those are, I think, some important details and tips for non-cash contributions. So let me go back to the tax tips and back to our 5 most common underutilized or non-utilized tax deductions. And the third one is travel. Everybody likes to travel. Do you like going to a warm location like Miami? Perhaps there's a seminar there that relates to your business. Do you like skiing in Colorado? Perhaps there's a convention there for your industry. Everybody likes New York City. I'm sure there's plenty of clients and customers and connections in New York City. Maybe you have customers in such vacation hotspots as Des Moines or Butte or someplace like that where I'm sure you're all clamoring to go visit. Well, hey, your customers are where they are. So when you're traveling there, the travel expenses we're talking about are the expenses to get there, such as airfare, train fare, vehicle expenses, and while you're there, hotels, meals, could also include things like taxis and tolls, internet connections in your hotel, dry cleaning, tips, all kinds of things that relate to travel. Again, the ordinary and necessary expenditure rule must apply. And also, we're generally talking about travel to see customers, vendors, suppliers, clients, etc. That's primarily what we're talking about, in addition to seminars, education, trade shows, things of that nature. Documentation of those items is the key, and you also, if you're not really good at keeping the documentation, there is a federal standard per diem rate that's published by geographic location that lets you use a standard rate per day, which is typically less than what you might actually spend, but it, if you want to keep the receipts, which you should do, then you'll probably get a bigger deduction. One tip that I want to give you relating to travel, which is a little known tip, that if you're staying in a hotel, and typically the hotel is a restaurant, which you might go there for dinner or for breakfast, if you put that restaurant charge on your credit card, it falls under the meals and entertainment category and is only 50% deductible. If you put it on your hotel bill and pay it with your hotel bill, it becomes part of the travel lodging and is 100% deductible. So that same meal on the hotel bill is 50% more beneficial than if you just paid by credit card. Another area I want to talk to you about is computers, and particularly all the home electronics and gizmos that everyone seems to have. I know my wife, among other people, loves everything that has the initial I in front of it. iPhone, iTouch, iPad, iPod, whatever it is. And so do apparently most of America. If you are using these items at home, principally for business purposes, you may be able to get a tax deduction out of it, and sometimes people overlook this. So this would not only include those items like your PC, your laptop, your iPad, but also could include the peripherals like printers, scanners, fax machines, things like that. I would suggest that if you have a computer, you put it in your home office if you have a home office. And one other thing, if you are an employee, to deduct any of these items, it has to meet 2 criteria. It has to be a condition of employment, and it has to be for the convenience of the employer. So it's a stricter standard if you are an employee. The last area I want to go over is the home office deduction. The home office deduction, I can't tell you how many times during the year people ask me about home office deductions, and a lot of people are afraid to take the home office deduction because they feel like they're going to get audited if they do. And while I would say that it may put you in a slightly higher audit category to take the home office deduction, if it's a legitimate deduction, I would not be afraid of it. You're entitled to take it. Please take it. So you need to evaluate that audit risk versus tax benefit, and it's one of the things you can discuss with us. Form 8829 is the form where you claim home office deduction, and IRS has a publication, Pub 587, that's just devoted to home office deductions. It's 32 pages just devoted to home office deductions. So there's a lot on that. So to claim a home office deduction, you have to meet two primary tests: regular use and exclusive use. Exclusive is easy. The room has to be just an office. I do a lot of work at night at my kitchen table, but guess what? At the end of the day, it's still a kitchen. It's not exclusively a home office. It does not qualify for the home office deduction. So make sure your home office is a separate room devoted just for the home office. Regular use typically means where you see customers or clients or patients in the normal course of business. The orthodontist that I took my kids to over the years, he had his office in his home. He saw patients there all the time. That's a great example of qualifying for regular use. But it's not the only example. If you have no other office to go to, and this is where you do your work, you will qualify for a home office deduction. If you do have an office and you have an office at home, then there's other factors that come in, something called the relative importance test. What is more important, the office that you go to conduct your business or the office in your home where you conduct your business? So you have to evaluate which one is more important. There are some exceptions to that, and one of the exceptions is if you don't have confidential storage place in your regular office and you need to keep payroll records or other sensitive records, then your home office may qualify. So please consult with us as to when your home office qualifies and when it doesn't. If it qualifies, you're talking about either a percentage of the square footage of that room compared to the whole house, or alternatively, the number of rooms in the house compared to the one office room. So for example, if you have 8 primary rooms, exclusive of bathrooms, basement, etc., and one of them is an office, then 1/8 of the expenses of your house are tax deductible. That's mortgage interest, real estate taxes, homeowners insurance, utilities. Also can be, people sometimes forget about alarm. They forget about exterminating services. They forget about heating and air conditioning contracts. Those all apply to the house. One thing that you need to know, some people think that the outside maintenance is tax deductible, but it is specifically excluded. So your lawn mowing, your landscaping, none of that is allowable for your home office deduction. And I do want to say that for repairs, if you do repairs to the specific home office room, it's 100% deductible. If you do repairs to the entire house, like the heating and air conditioning system or the roof, that percentage is deductible. If you do repairs to a room specifically that has nothing to do with the home office, like for example the master bedroom, has nothing to do with the home office, you can't deduct any of that. There's also rules on depreciating your home office. So in other words, if 1/8 is the percentage, 1/8 of the cost of your house can be depreciated. But there are other types of things that you need to be aware of, like the depreciation may be recaptured as income when you go to sell your house. And there's other issues about selling your house and ways to convert the house back to principal residence at some point prior to the sale. We can advise you on all those nuances. Please contact us if you think the home office is applicable or if you're contemplating sale of your home. So once again, those are some of the 5 most commonly underutilized or overlooked tax deductions. And let's go back and take a couple other questions. David, are there other questions that we may have?
Yes, we have a question from Marty. And the question is, to document my travel, meals, etc., do I need to keep the real receipt or can I enter it in QuickBooks?
One of you guys want to take that?
Well, you ideally should keep the real receipt there and note on the receipt what the actual purpose of the travel. So although you obviously want to enter it in QuickBooks, I don't believe that would be sufficient for the IRS. I think they're going to want a receipt that reports the purpose of the travel and any other things that apply to the trip to make it deductible. So I don't know if you guys want to expand on that at all.
I do. One of the Internal Revenue examinations that we had recently, the agent specifically made a point of saying a lot of taxpayers think that just by entering their expense in QuickBooks that is sufficient documentation. And he was very clear that it is not. Entering it on QuickBooks is not proof to IRS that A, the expenditure actually was made. They want proof of that. And B, that it was a legitimate business deduction. So just because it was in QuickBooks doesn't mean it was a legitimate business deduction, so you need to keep that proof as well. David, any other questions?
Yes, we have a question from Marcus, and he's thinking about refinancing the mortgage on his house. He wants to know, will the interest be deductible?
One of you guys want to take that?
I can take that one.
Okay, go ahead, Barry.
Yeah. The outstanding interest from the original mortgage should still be deductible when you refinance. But if you come out with more money, if you take money out of the equity of your home so your mortgage now goes up, the additional interest associated with that additional mortgage may not be deductible. For example, if the original mortgage was $300,000, the balance was $300,000, and you refinance for $400,000, 3/4, then 3/4 of the interest will still be deductible, but the additional quarter, the additional $100,000, may not be deductible. If you use that $100,000 for home improvements, then it probably will be deductible. The full $400,000 will probably be deductible. This one, before you refinance and spend the money like that, make sure you contact us if that's something you're looking to do.
Thanks, Barry. I could see one of the questions that came in says, which team do you think is going to win the Super Bowl? I think we'll defer on that, maybe to a different day. David?
I can take that one if you want.
Yeah, I'm sure you can. David, any other questions?
Yes, we have a question from Bob. And Bob is interested in knowing some of the noteworthy tax law changes for 2011.
I can take that question there, and it's actually something I came prepared for this because being in the tax field, we get asked that question quite a bit. So there actually have been quite a few tax law changes, but many of them don't apply to the everyday average return, and I guess you could define that in various ways, but a lot of them are specific to certain circumstances there, and particularly if you converted or rolled over a tax-deferred retirement account in 2010 to a Roth account, you will now have to report 50% of that distribution as income on your 2011 tax return, and you'll report the other 50% in 2012. So for any Roth conversions, please remember to take that into account in filing your 2011 tax return. Another question that actually is very important to the IRS is for any foreign bank accounts. If an individual has a foreign bank account of $50,000 or more, or married filers of $100,000 or more, they'll now be required to file new Form 8938 to report these accounts. Another change is the Making Work Pay credit is no longer valid for 2011. And another change that applies specifically to our industry has to do with e-filing. Our firm is now required to e-file returns because we file more than 11 individual and trust tax returns. So basically, all tax returns now must be e-filed. There are some exceptions, but generally, this is the way we'll need to be going in the future here. One other thing I wanted to mention here in regard to power of attorney is Form 2848. If you need IRS representation, a married couple can no longer file one Form 2848 for the power of attorney. They have to now file separate power of attorneys and file them with the IRS. So please keep that in mind if you do need IRS representation.
Thanks, Mike. I do want to let you know that we have days of training on the tax law changes each year. So to go over the tax law changes in a couple minutes would just really be impossible. And I know, Mike, you hit on some of the things that you thought are of general interest. I do want to go back to the foreign bank account and foreign investment reporting because it winds up involving more people than you might think. that have bank accounts in foreign countries, either because they have relatives there or because they tend to travel there. We see a fair amount of that, and the penalties, I believe, are pretty stiff for that, aren't they, Mike?
Yes, they are. They're very stiff, yeah.
Yeah, I think it's something like $10,000 for failure to file. So if that applies to you or anyone you know, we really urge compliance. And it's not a complicated form. It just lists some information on it so the government is aware of people that have foreign bank accounts. So in any event, we're running to the end of our time here. I want to thank you for tuning into this webinar. The webinar will be posted at some point on our website, and you will be able to access that. Look for future information on future webinars. Please friend us on Facebook and on LinkedIn, and follow some of our postings. We do have regular postings on tax tips and information that we think is helpful for you. Again, my thanks to Mike and Barry and David from our tax department, and to Bernie and Marty from Mid-Atlantic Video Streaming. And thank you so much for joining us. You can contact us at Bormel, Grice & Huyett P.A. 301-953-3259, or in the Baltimore area, 410-792-7259. You can check our email, our website at bormel-grice.com, or any of us, first initial, last name, at bormel-grice.com. Thanks so much for joining us. Have a nice day.